Soros became a billionaire by shorting the British pound, crushing the Bank of England in the process.
Investor Paul Tudor Jones is here.
A man shrouded in political controversy.
Stanley Druckenmiller.
A legendary activist investor, Bill Ackman, who has been part of some of the biggest and at times controversial trades in history.
If you spend any time reading about trading or investing, you have probably come across these big names. The legendary George Soros, who's often in the news here in India for everything but his financial acumen. His protege, Stanley Druckenmiller, who has his own followers. Paul Tudor Jones of Black Monday fame when he famously predicted and profited from the 1987 crash. And in more recent times, folks like Ray Dalio and Bill Ackman. And of course, how could I forget Bobby Axelrod from the series Billions, a character inspired by Steve Cohen of Point72. So what ties all these people together? They built and ran hedge funds managing billions of dollars of client money and finding ways to profit from the markets. But here's the thing, when it comes to India, we hardly ever hear about hedge funds or hedge fund managers for that matter. Why is that? That's exactly what we are going to explore in this episode. I'm your host Sandeep Rao, and this is an episode about what is a hedge fund and do we have them in India. As with everything, let's begin with the beginning. You've got to hear this fascinating story of how and who gave birth to the idea of a hedge fund. This is the story of Alfred Winslow Jones. Not a Wall Street prodigy, not a Goldman Sachs alum, not even a trained economist. Jones was born in 1900 in Melbourne, Australia, but his life journey went far and wide before leading him to the world of finance. In his youth, he worked as a sailor on cargo ships, traveling the world and absorbing ideas along the way. Later, in Berlin, he studied Marxism and even ran secret missions for an anti-Nazi underground group. During these years, his circle of friends included writers and rebels. He famously shared drinks with Ernest Hemingway in Spain, where he and his wife honeymooned against the backdrop of Spanish Civil War. So hardly a resume for a future Wall Street innovator, right? And yet, at 48, while working as a journalist for the Fortune magazine, Jones stumbled into the world of finance. In March 1949, he was assigned to write an article titled Fashions in Forecasting, a straightforward piece on stock market prediction methods. It's a must-read if you are a financial history buff. I'll link it in the show notes. But here's the twist. In the course of researching that article, Jones decided to put theory into practice. With $100,000, part his own savings and part from investors, he launched a fund that combined long positions, short selling, and leverage. If you are new to the concept of short selling, I'll link a varsity explainer in the show notes. Back to Jones. So what started as a journalist's experiment went on to become the blueprint for the world's first hedge fund. This simple idea of combining long and short positions along with leverage grew into a multi-trillion-dollar industry, one that still runs on the same principles Jones laid down. This isn't just a story about finance, it's a story of a curious outsider who shaped how the rich world invests. So that brings us to the key question. What exactly is a hedge fund and how does it work? You see, when we talk about mutual funds, they are typically long-only funds. That means fund manager takes your money and buys stocks, hoping they will go up over time. Simple as that. And when you invest, say 1 lakh in a mutual fund, you get units worth 1 lakh barring costs like stamp duties, etc. The fund isn't borrowing extra money or taking leverage on top of that. It invests what you put in, nothing more. But hedge funds are different. They can go long on some stocks and short on others, betting not just on prices rising, but also on prices falling. They can also use leverage, which is borrowed capital. So your 1 lakh could actually be controlling 3 to 5 lakhs worth of positions. The term hedge in hedge fund refers to the original strategy Jones used, that is hedging long stock positions with short positions. By going long on undervalued companies and shorting overvalued ones, he aimed to reduce the overall market risk while still capturing returns. Let's take an example to understand this. In India, if you want to build a long-short portfolio, the first step is to find a way to filter undervalued stocks and overvalued stocks. Suppose your filter identifies HDFC Bank, Infosys, and Asian Paints as undervalued, you would then take long position in these stocks by buying them in the cash market. Next, you look for stocks that your filter flags as overvalued, say Zomato, Paytm or Vodafone Idea. Since you can't short sell these stocks in the cash market beyond intraday, you would have to short their futures contracts instead. By doing so, you balance your portfolio with equal long and short exposure. This way, your gains don't depend only on the markets going up. Instead, you are either betting on your long stocks doing better than your short positions, or you're betting that both your long and short positions work in your favor, in a way profiting on both the sides. And this irrespective of what the broader market does. Now, this is a simple illustration of how a long-short portfolio can be constructed in practice. Do note, this is just one of the many ways of creating a hedged portfolio. You can also hedge a portfolio by simply buying puts. So yeah, over time, the hedge fund industry expanded far beyond simple hedging into global macro bets, quant strategies, distressed debt, and more. But the name hedge fund, that stuck on. On top of that, hedge funds have the freedom to trade across asset classes, equities, bonds, currencies, commodities, and derivatives of these assets. So if I have to compare, while a mutual fund is like a steady car ride on a highway, a hedge fund is more like a high-performance race car, faster, riskier, and designed for those who understand the thrill, the danger, and the possible payoff if they win. But there's another big difference in terms of how the hedge fund managers get paid. In mutual funds, fund managers are paid by the AMC through a mix of salary and bonuses. The money comes from the TER, total expense ratio, charged to investors, which is capped by regulation in both the US and in India. Performance fees are not allowed, so managers cannot take a direct cut of the profits. Their variable pay is instead tied to the fund performance, AUM growth, and the AMC's profitability. US hedge funds, on the other hand, flip that model. They usually charge using the 2 and 20 model, which is 2% of AUM charged as management fee and 20% of profit as performance fee, also known as carry, which is short for carried interest. In other words, a hedge fund manager's earnings are tied directly to how well the fund performs. If they make money for you, they make money for themselves, and a lot of it at that. This pay structure was one of Jones's second biggest innovations. It aligned the manager's interest with the investor's interest, and it became a standard of sorts for the hedge fund industry across the world. With that, let's come closer home and ask the obvious question. Do we have hedge funds in India? The short answer is yes, we do. We have hedge-fund-like vehicles that exist under the category of alternative investment funds, or AIFs as they are known, particularly Category III AIFs. They can use strategies similar to hedge funds, long-short positions, derivatives, and leverage within limits. I call them hedge fund-like because there are significant differences in terms of how they operate in India. 1. In the US, the hedge fund itself doesn't come directly under the SEC in a way a mutual fund or an ETF would. Hedge funds usually operate under exemptions in the Investment Company Act. So they avoid retail-style rules on disclosures, diversification, or leverage. But the hedge fund manager does come under SEC's oversight. Most managers must register under the Investment Advisors Act, file periodic reports, and meet other regulatory obligations. This means the SEC supervises the people running the fund, not the fund structure itself. That's the reason why US hedge funds enjoy significant flexibility in terms of how they invest. Now contrast this with India. Category III AIFs, the closest equivalent to hedge funds, are directly governed by SEBI regulations. Everything from the minimum ticket size, permitted leverage, risk disclosures, to even how performance fees can be structured is explicitly regulated at the fund level. In other words, while US hedge funds are lightly regulated entities with oversight mainly on the manager, Indian AIFs are heavily regulated products right down to their structure and operations. 2, and perhaps the most important difference, is in terms of leverage restrictions. In the US, one of the striking features of hedge funds is that there are no hard statutory cap on leverage. If a fund raises $1 million, it could, in theory, borrow several times that amount. Their reasoning is, since hedge funds are open only to accredited investors, that is, wealthy individuals and large institutions, such sophisticated investors don't need the same protections as retail investors, so hedge funds are granted far more flexibility. However, in India, Category III AIFs face explicit leverage restrictions. SEBI rules clearly state that the gross exposure cannot exceed twice the NAV, that is the net asset value of the fund. So it's 2x leverage at max on the market value of the investment. Use of derivatives and short positions all fall under this 2x cap. On top of that, AIFs must maintain detailed risk management and reporting processes to ensure these limits are never breached. And it's worth noting that in India too, these funds are not really retail products. Investors need to commit a minimum of 1 crore to participate. So just like the US, access is limited to high net worth individuals and institutions, but unlike the US, the funds themselves are far more heavily regulated. The other major difference is in the fee structure. In the US, hedge funds became famous for the classic 2 and 20 model, something I spoke about earlier. In India, Category III AIFs don't have the same flexibility. While managers can charge management and performance fee, SEBI regulations impose tight rules on how these are structured and disclosed. Performance fee often needs to be linked to a hurdle rate, a minimum return threshold the fund must cross before charging a share of profits, and the calculation methodology must be clearly spelled out in advance. So while the US fund managers can strike fee deals relatively freely with their investors, Indian AIFs are much more standardized and investor protection oriented. That makes them less lucrative for the fund managers compared to their global peers, but arguably safer for the investors. 4. Taxation. In India, most Category III AIFs are structured as trusts, and this comes with a big drawback. They are taxed at the maximum marginal rate of about 42.7% at the fund level. This means profits from derivatives and short-term trades get taxed before they even reach the investor. In practice, this takes away a significant portion of returns. Combine that with the strict leverage restrictions, and it severely limits the fund manager's ability to generate true alpha. In the US, hedge funds operate under much lighter tax treatment. They are typically structured as pass-through entities, meaning the fund itself is not taxed, much like how mutual funds are treated in India. Instead, profits and losses pass through directly to the investors, who then pay taxes according to their own individual situation. This preserves the gross returns of the fund and gives US fund managers far more room to pursue aggressive alpha-generating strategies. Now, these are the real reasons why we don't have celebrity hedge fund managers in India, the kind who make headlines for generating eye-popping returns and taking bold bets. Our regulatory, leverage, fee, and tax frameworks simply don't allow for that kind of risk-taking or scale. At the same time, one has to acknowledge that in India, investor protection has always been the key priority. But here's the silver lining. You can take inspiration from Alfred Winslow Jones so long as you are sufficiently capitalized as an individual and willing to put in the work. You can still design and run those strategies that are similar to those of the US fund managers. It may not come with the same structure, scale, or spotlight, but the core principles remain unchanged. And that's the note of possibility I'll leave you with. And lastly, if you're curious to dig deeper into the world of hedge fund managers and their stories, I'd recommend 2 excellent books. The first is More Money Than God, Hedge Funds and the Making of the New Elite by Sebastian Mallaby. The book details a sweeping history of hedge funds from Alfred Winslow Jones all the way to the quants of today. Next is a book titled Hedge Hogging by Barton Biggs. It takes a candid insider look at the life in the hedge fund world, filled with war stories, lessons, and the human side of money making. Both are must-reads if you want to understand not just how hedge funds work, but also personalities and mindsets that shape this fascinating industry. I hope you found this perspective useful. Share your thoughts in the comments and I'll do my best to respond. Thank you for watching, and as always, be careful with your capital.